Most people buy one or two popular ETFs like VU or VTI and never look any further. Nothing wrong with that, but it also means they're ignoring more than 90 other funds sitting on the same platform. In this video, I'm testing every Vanguard ETF one could find, including Dividend ETFs, bond funds, sector funds, growth ETFs, value ETFs, international funds, and even a few strange ones almost nobody talks about. I took $10,000 and ran it through every single fund, then ranked them all to find the best performer in every category. And by the end of this video, I'll show you the Vanguard ETF that quietly turned $10,000 into over $90,000 in the last decade, plus another ETF that barely anyone owns, yet somehow outperformed almost every dividend fund, most sector funds, and even several aggressive growth ETFs. Now, testing nearly 100 ETFs sounds simple until you actually try doing it. You start opening dozens of tabs, comparing expense ratios, checking historical returns, copying numbers into spreadsheets, and trying not to accidentally mix up ticker symbols. After a few hours, everything starts looking the same. It becomes a complete mess. So instead of doing it manually, I built the research a different way. I pulled every Vanguard ETF into one giant database, filtered out duplicate listings, organized the funds into categories, and compared everything side by side. 10-year returns, 1-year returns, dividend yields, volatility, expense ratios, total assets, all on one screen. That's how this video exists. Here are the rules. Every ETF starts with the same $10,000 investment. I'm looking at two different time periods. The first is the 1-year return, which shows what happened recently. The second is the 10-year return, which matters much more because it includes everything: market crashes, inflation spikes, interest rate hikes, recoveries, the AI boom, and one of the strongest tech rallies in history. 1 year can be luck. 10 years usually reveals the real winners. Any ETF without a full 10-year history can still appear in the rankings, but it cannot win the overall crown. 10 years is the minimum requirement. First, let's talk about bond ETFs. I know nobody clicks on investing videos excited to hear about bonds, but they're important because they reveal what happens when markets get ugly. Vanguard's best performing bond ETF over the last decade was one focused on higher yield corporate debt. It didn't generate massive returns like tech stocks, but it steadily compounded, while safer bond funds struggled to grow at all. Meanwhile, some long-duration bond ETFs barely moved over the entire decade because rising interest rates crushed bond prices. That's how bonds work. When new bonds start offering higher interest rates, older bonds become less attractive, and their prices fall. The difference between the best and worst Vanguard bond ETF was only a few $1,000s over 10 years. That sounds decent until you compare it to the sector ETFs later in this video, where the spread becomes tens of thousands of dollars. Bonds protected wealth. They didn't multiply it. Next came international ETFs, and this category produced one of the strangest patterns in the entire test. For most of the last decade, US stocks dominated global markets. American technology companies grew faster, profits exploded higher, and international markets simply couldn't keep up. That meant many Vanguard international ETFs underperformed badly for years. But then the last 12 months completely flipped the rankings. Suddenly, emerging markets, European equities, and foreign dividend funds started outperforming. ETFs that looked weak over the 10-year period jumped near the top in the 1-year rankings. Cheap valuations, stronger foreign currencies, and money rotating out of expensive US stocks helped fuel the comeback. The long-term winner was still US exposure, but the short-term winners came from outside America. Then I moved into Vanguard's Dividend ETFs, one of the most popular categories among long-term investors. Most people think dividend investing means slow growth and safety, but one Vanguard Dividend ETF almost kept pace with aggressive growth funds across the entire decade. It quietly compounded year after year while paying investors steady income the whole time. Another dividend ETF, performed especially well during inflationary periods because the companies inside it had strong pricing power and rising cash flows. But the biggest surprise was how different the 1-year rankings looked compared to the 10-year rankings. Several international dividend ETFs that sat near the bottom over the decade suddenly became top performers. In the short term, it was one of the clearest examples in this entire project showing how quickly market leadership can change. After dividends came factor ETFs, a category most investors barely understand. These funds don't simply track the market. Instead, they filter stocks based on specific characteristics. Momentum ETFs buy stocks already moving higher. Value ETFs focus on companies that look cheap relative to earnings. Quality ETFs target businesses with strong balance sheets and reliable profits. Minimum volatility ETFs aim for smoother performance during market downturns. What surprised me most was how powerful momentum investing turned out to be. Over the last decade, Vanguard's momentum-focused ETFs beat most dividend funds, most international funds, and even several active managers. Meanwhile, low volatility funds protected investors during rough periods but lagged badly during major bull markets. The results showed something important. Different investing styles dominate during different market conditions. There is no single strategy that wins forever, but the real monsters lived inside the sector ETF category. This is where the biggest returns in the entire video appeared. Vanguard's technology ETF completely crushed the competition. Over the last decade, $10,000 turned into more than $90,000. Investment multiplied more than 9 times. And once you look at the holdings, the reason becomes obvious. Apple, Microsoft, Nvidia, Broadcom, and other giant technology companies dominated the fund. The rise of AI, cloud computing, smartphones, semiconductors, and software infrastructure pushed those stocks relentlessly higher for years. The ETF simply held them while the entire technology revolution unfolded. But here's the interesting part. Another Vanguard ETF nearly caught it. And almost nobody talks about this fund. It wasn't a pure tech ETF. It wasn't a dividend strategy. It wasn't actively managed. Instead, it held a broader collection of growth companies across multiple sectors. Yet somehow, it still outperformed nearly every ETF Vanguard offers. That became the most interesting story in the entire project because it showed something most investors forget. Sometimes broad exposure to innovation beats concentrated bets over the long run. So after testing and ranking every Vanguard ETF, 2 funds clearly separated themselves from everything else. The pure return winner was the technology ETF. Nothing else on the platform came close over 10 years. But the more fascinating winner was the broader growth ETF that nearly matched those returns while holding a much more diversified portfolio. One fund represented concentrated dominance, the other represented the power of long-term growth, investing across the broader market. And honestly, that second story may matter even more over the next decade than the first one. Now, before we start ranking winners, we need to talk about how this experiment was actually built, because the research process matters more than most people realize. Anybody can open a chart, zoom into a 5-year bull market, and point at whichever ETF happened to go straight up. That's easy. The hard part is building a system that compares dozens of different funds fairly without accidentally manipulating the outcome. And once you start testing nearly 100 ETFs at the same time, things get complicated very fast. At first, I thought this project would take maybe one afternoon. Open Vanguard's ETF page, copy the ticker symbols into a spreadsheet, pull the returns, organize the data. Done. That was the plan. Then I actually started doing it. Within an hour, I had dozens of browser tabs open, multiple spreadsheets covering my screen, and a growing realization that this was going to become a complete nightmare if I didn't build a better process. Because here's the problem. ETF research sounds simple until you realize every website measures performance differently. Some show annualized returns, others show cumulative returns. Some include dividends automatically. Others don't. Some funds have share class variations. Some ETFs are cross-listed on different exchanges. Some launched recently and don't even have a full 10-year history. And if you accidentally compare to different return methods, your rankings become useless immediately. So instead of manually checking every ETF one by one, I rebuilt the process from scratch. I pulled every Vanguard ETF into one centralized database and started filtering the list down systematically. First, I removed duplicate listings. A surprising number of ETFs appear multiple times depending on the exchange or currency version. If you leave duplicates in the rankings, you can accidentally count the same fund twice. So every ETF had to be cleaned and verified before the comparison even started. Once the duplicates were removed, the list became much more manageable. Then came the categories. Because comparing a bond ETF to a technology ETF without context tells you almost nothing. Of course, tech beat bombs over the last decade. That isn't interesting. The interesting question is which bond ETF beat the other bond ETFs? Which dividend fund dominated the dividend category? Which international ETF survived the difficult years the best? That's where the real comparisons happen. So I divided the entire Vanguard lineup into segments: bond ETFs, international ETFs, dividend ETFs, sector funds, growth ETFs, value ETFs, factor ETFs, real estate funds, commodity-related funds. Every ETF had to belong somewhere. And once the categories were organized, the patterns started becoming visible almost immediately. Some segments were tightly grouped together, where nearly every ETF produced similar results over the decade. Other categories were absolute chaos, with enormous performance gaps between the top and bottom funds. That difference alone revealed a lot about where market leadership actually came from during the last 10 years. Then came the metrics, and this part matters because most investors focus on only one number, return. But returns without context can be misleading. A fund can generate incredible returns simply because it took massive risk during a perfect market environment. So alongside performance, I tracked several other metrics at the same time. Expense ratio was one of the biggest, because even though Vanguard is known for low-cost investing, not every ETF is equally cheap. Some specialized funds charge significantly higher fees than the broad market. ETFs people usually buy over a 10-year period. Those costs compound quietly in the background. A tiny difference in fees can translate into thousands of dollars over time. So every ETF needed to be judged not only by how much money it made, but by how efficiently it made it. I also looked at dividend yield, because some ETFs produce a large percentage of their returns through income rather than price appreciation. That's especially important in categories like dividend funds, REITs, and bond ETFs. A fund might look weaker on pure price growth, while still delivering strong total returns once dividends are included. Ignoring that would completely distort the rankings. Then there's volatility. Some ETFs produced amazing long-term returns but experienced brutal drawdowns during crashes. Others moved much more steadily but never reached the same highs. That trade-off matters depending on the type of investor looking at the results. A 20% annual return sounds incredible until you realize the fund lost 45% during a downturn and half the investors panic sold at the bottom. Numbers alone don't tell the whole story. Investor behavior matters too. Once the database was fully built, the next step was choosing the time frames. And this is where a lot of ETF analysis online completely falls apart. Because if you pick the wrong time frame, you can make almost any ETF look like a genius investment. Look at energy ETFs during the oil rally after the pandemic. For a few years, they looked unstoppable. But zoom out further, and you suddenly see the brutal collapse that came before it. The same thing happens with innovation funds, biotech ETFs, real estate funds, almost everything. Short windows distort reality. So I used the timelines only, 1 year and 10 years. The 1 year return shows what's happening now. It captures momentum, recent market rotations, and the sectors currently attracting money. But 1 year is emotional. It's noisy. It reflects headlines and short-term trends. 10 years tells a completely different story. 10 years includes multiple market environments. It includes bull markets, crashes, inflation spikes, recoveries, interest rate cycles, wars, recessions, and shifts in investor psychology. If an ETF dominates over 10 years, that usually means something structural is happening underneath the surface. That's why the overall winner in this video is based entirely on the 10-year results. 1 great year can happen by luck. 10 great years usually means the strategy genuinely worked. Now, not every Vanguard ETF qualified for the final rankings. Some funds launched recently and simply don't have enough history yet. Those ETFs still appear in their categories because they can provide interesting short-term comparisons, but they cannot compete for the overall crown. 10 years was the entry fee, no exceptions, because otherwise newer ETFs could benefit from only existing during favorable market conditions. A technology fund launched after the 2020 crash would look incredible simply because it avoided the earlier downturns. That wouldn't be a fair comparison against funds that survived the entire decade. Another thing I noticed while building the rankings was how much investor psychology influences ETF popularity. Some of Vanguard's most discussed ETFs weren't even close to the best performers. Meanwhile, several top-performing funds had almost no public attention at all. Investors tend to crowd into whatever feels familiar. Broad market index funds dominate discussions because they're simple and safe. Dividend ETFs attract attention because passive income sounds emotionally satisfying, but some of the strongest performing ETFs in the entire dataset were funds most investors barely recognize by ticker symbol. That disconnect between popularity and performance became one of the most interesting themes in the entire project. Then came the visual organization. Once all the data was cleaned, categorized, and standardized, I built side-by-side comparisons showing how each ETF transformed the same starting investment. Every fund began with $10,000, and instead of only displaying percentages, I converted everything into actual dollar outcomes. Because percentages sound abstract, but seeing one ETF turn $10,000 into $18,000, while another turned it into $90,000, makes the gap feel real immediately. It changes the emotional impact of the numbers. Most investors don't think in CAGR percentages, they think in actual money. What would my account look like today? That's the question people really care about. And once those comparisons were complete, the patterns became impossible to ignore. Technology dominated the decade. That part wasn't surprising, but the scale of the dominance was shocking. Some sector ETFs produced outcomes that completely separated them from the rest of the market. Meanwhile, categories traditionally viewed as safe, like bonds and low volatility funds, massively lagged during long stretches of economic expansion. International ETFs spent years underperforming before suddenly showing signs of life recently. Dividend ETFs delivered much stronger growth than most people expect, and factor funds, especially momentum-based strategies, quietly became some of the strongest performers in the entire Vanguard lineup. One of the strangest discoveries came from comparing 1-year returns against 10-year returns side by side. Some ETFs completely flipped positions depending on the timeline. A fund sitting near the bottom over 10 years suddenly appeared near the top in the 1-year rankings. Others dominated the decade, but recently slowed down dramatically. That difference revealed something important about markets. Leadership changes constantly in the short term, but long-term trends usually come from a small group of persistent winners. Over the last decade, those persistent winners overwhelmingly came from growth-oriented US equities, especially technology-heavy funds. I also realized how misleading diversification can sound without context. Some ETFs marketed themselves as diversified, but were still heavily dependent on a small number of companies underneath the surface. A broad growth ETF might technically hold hundreds of stocks, while still allocating enormous weight to Apple, Microsoft, Nvidia, and Amazon. So even diversification had layers to it. Some funds appeared concentrated because they openly targeted a specific sector. Others looked diversified until you examined the holdings closely and realized the same. Mega-cap tech companies were quietly driving most of the returns anyway. That became especially obvious in the final rankings, where a handful of dominant companies repeatedly appeared across multiple winning ETFs. Another important piece of the research involved understanding market conditions during the decade itself. Because ETFs don't exist in isolation, their performance reflects the economic environment around them. The last 10 years included near-zero interest rates, aggressive monetary stimulus, rapid technological innovation, the COVID crash, supply chain disruptions, inflation spikes, and the rise of artificial intelligence. Certain ETFs benefited enormously from those trends. Others suffered because the environment worked directly against their strategies. Real estate funds struggled during rising rate periods because higher borrowing costs hurt property values. Bond ETFs suffered when interest rates climbed aggressively. Energy funds experienced violent swings depending on oil prices. Technology funds exploded higher during periods when cheap capital and digital transformation accelerated growth. Understanding those macroeconomic forces helped explain why certain categories dominated while others lagged up. By the time the research process was finally complete, the spreadsheet had turned into something much larger than a simple ETF ranking. It became a snapshot of the entire market cycle of the last decade. Every ETF category told a different story about investor behavior, economic conditions, and long-term trends. Bonds told the story of interest rates. International funds told the story of America's dominance over global markets. Dividend ETFs told the story of stability and cash flow. Sector ETFs told the story of technological disruption. Factor funds told the story of how different investing styles rise and fall depending on the market environment. And once all the rankings were finalized, two things became very clear. First, the gap between average ETFs and elite ETFs was far larger than most investors realize. We're not talking about small percentage differences. In some cases, the top-performing ETFs generated outcomes several times larger than the weakest funds from the exact same company. Second, the biggest winners often came from places most investors weren't paying attention to. Not the ETFs with the loudest marketing, not the funds most frequently discussed online. The real winners were usually tied to larger economic trends quietly reshaping the market underneath the surface. And that's where the rankings start getting interesting, because once the research was done, the actual results looked nothing like what most investors would expect. Alright, let's start with the category almost nobody gets excited about, bond ETFs. And look, I understand it. Nobody opens YouTube hoping to hear someone passionately explain treasury durations and yield curves. Bond funds don't usually produce life-changing returns. They don't create overnight millionaires. Nobody screenshots a 6% bond rally and posts rocket emojis on social media. But bonds matter. Actually, they matter a lot more than most investors realize, because bonds tell you something extremely important about the market. What happens when growth disappears? When stocks are flying higher, bonds look boring. But when fear enters the system, suddenly everybody remembers why bonds exist in the first place. And over the last decade, bond investors experienced one of the strangest environments in modern financial history. 4 years, interest rates stayed near zero. Then inflation exploded. Then central banks started hiking rates aggressively at a pace the market hadn't seen in decades. That combination completely changed the bond market. Some bond ETFs survived surprisingly well. Others got absolutely crushed. And once I ranked every Vanguard bond ETF side by side, the gaps became much larger than I expected. Now, before we get into the rankings, we need to quickly explain what these bond ETFs actually hold, because not all bond funds are remotely the same thing. Some bond ETFs hold US Treasury bonds, which are backed by the Federal government, and, considered extremely safe, others hold corporate bonds, which means companies borrow money from investors and pay interest in return. Then you have high-yield bonds, sometimes called junk bonds, where lower credit companies offer higher interest payments because the risk of default is higher. Then there are international bond funds, municipal bonds, mortgage-backed securities, inflation-protected bonds, short-term bonds, long-term bonds, and every one of those categories reacts differently, depending on what the economy is doing. So when people casually say bonds are safe, that statement leaves out a massive amount of context, because some bond ETFs barely move. Others behave almost like stocks during stressful periods. Now here's the setup for this segment. Every Vanguard bond ETF starts with the same $10,000 investment. We're comparing to time periods, 1-year returns, 10-year returns, and the 10-year return is what matters most, because it captures the entire interest rate cycle, the low rate years, the COVID crash, the inflation spike, and the aggressive Federal Reserve hikes that followed. This wasn't a normal decade for bonds, not even close, and that's exactly why this segment became so interesting, because for years, bond investors operated in a world where rates were artificially low, money was cheap, borrowing exploded, yields collapsed, and investors searching for income kept moving further out on the risk curve, just trying to earn something above inflation. Then inflation showed up and changed everything. Suddenly, old bonds paying tiny yields looked terrible compared to newly issued bonds offering much higher rates. And when that happens, existing bond prices fall. That's the key mechanic most people miss. Bond ETFs don't just sit there collecting interest payments. Their market value changes constantly depending on interest rates. And the longer the bond duration, the more sensitive the fund becomes to rate changes. That distinction ended up defining almost the entire category. Now let's look at the actual rankings. The best performing Vanguard bond ETF over the last decade was the high-yield corporate bond fund, not treasuries, not government bonds, not the safest option. The winner came from lower-rated corporate debt. And honestly, that makes sense once you understand how the last decade unfolded. For most of the 2010s, the economy stayed relatively stable. Corporate defaults remained low. Stocks rallied. Credit markets stayed healthy. And investors desperate for yield kept pouring money into higher-paying corporate bonds. That extra yield compounded steadily year after year. So while safer government bond ETFs crawled forward slowly, high-yield corporate bonds generated noticeably stronger returns. Now to be clear, the returns still weren't explosive compared to equities. This wasn't a technology ETF turning $10,000 into six figures, but inside the bond category itself, the difference was meaningful. The top-performing bond ETF turned $10,000 into roughly the mid-$16,000 range over the decade. Meanwhile, some of the weakest bond ETFs barely moved past $11,000 or $12,000 over the exact same period. Same company, same asset class, completely different outcomes, and the weakest performers almost all had one thing in common: long duration. Long-term bond ETFs got hit hard during the rate hike cycle, because when interest rates rise aggressively, long-duration bonds become a problem. Imagine owning a bond paying 2% interest, while newly issued bonds suddenly start paying 5%. Nobody wants your old 2% bond anymore, unless the price drops enough to compensate. That's exactly what happened across large parts of the bond market after inflation surged. Long-term Treasury ETFs suffered badly because their older, low-yield bonds became far less attractive in the new higher-rate environment. Shorter duration funds recovered faster because their bonds matured more quickly and could be replaced with higher-yielding debt sooner. That difference created a huge divide within the category, and this is where bond investing gets more complicated than most people think, because a bond ETF can be safe in terms of credit quality, while still being extremely sensitive to interest rate risk. A lot of investors learned that lesson the hard way recently. They assumed government bond ETFs would always protect them. Then rates exploded upward, and those supposedly safe funds lost significant value anyway. Now compared to equities, the losses still looked manageable, but psychologically, many bond investors weren't expecting volatility at all. That was the shock. The other interesting thing about this segment was how tightly grouped most of the returns actually were, unlike the technology ETFs later in this video, where the spread between winners and losers becomes enormous. Bond ETFs mostly stayed within a relatively narrow range. The difference between the top and bottom performer over 10 years was meaningful but not life-changing. That's the nature of fixed income. Bonds are designed more for stability and income generation than explosive growth. And honestly, this segment revealed something important about investor expectations. A lot of people buy bond ETFs hoping for safety, stability, and predictable returns. But the last decade proved that bonds are not immune to economic forces. Interest rates matter enormously. Inflation matters enormously. Central bank policy matters enormously. And depending on the environment, bonds can spend years underperforming expectations. Now let's look at the one-year rankings, because this is where things started shifting. Several bond ETFs that struggled over the long term suddenly improved once higher rates entered the system. Why? Because new bonds finally started offering attractive yields again. 4 years, investors were stuck earning almost nothing from fixed income. Now suddenly, safer bonds were paying meaningful interest again. That changed the math completely. Short-term treasury ETFs especially became more competitive because investors could finally earn decent yields without taking huge duration risk. Meanwhile, some longer duration funds remained weak because the damage from earlier rate hikes was still working its way through the system. This created an unusual moment where bonds started looking attractive again after years of being largely ignored, and you could actually see that transition happening inside the rankings themselves. Now another thing I noticed while analyzing these bond ETFs was how emotionally difficult they've become for younger investors to understand, because if you started investing during the last decade, especially after 2020, your brain was trained by a stock market dominated by technology and growth. You watched AI stocks explode upward. You watched tech ETFs triple and quadruple. You watched aggressive growth dominate financial headlines constantly. Compared to that environment, bond ETFs feel painfully slow. And mathematically, they were slow. There's no denying that. But that comparison can become dangerous because bonds serve a completely different purpose. They're not designed to maximize upside. They're designed to stabilize portfolios during uncertainty. The problem is that the last decade was unusually hostile toward traditional fixed income. Ultra-low rates left little room for appreciation. Then rising rates created price pressure. So bonds spent years stuck between weak yields and declining prices. That's part of why so many younger investors abandon them entirely. But markets move in cycles, and the exact environment that crushed bonds recently may eventually become the environment that makes them attractive again. That's another reason I wanted to include this segment in the video, because even though bonds didn't come close to winning the overall rankings, they still tell an important story about how different asset classes behave under different economic conditions. Now here's the key takeaway from this entire category. The bond ETFs that performed best over the decade generally took slightly more risk in exchange for a higher yield. The bond ETFs that struggled most were usually those heavily exposed to long duration interest rate sensitivity during a period of rapidly rising rates. In other words, credit risk helped, duration risk hurt. That pattern explained most of the rankings almost perfectly. And once you understand that, the rest of the results start making much more sense, because the same idea shows up again and again across every category in this video. The market rewarded whatever matched the environment, and over the last decade, the environment rewarded growth, technology, momentum, and risk-taking far more than traditional safety. That's why the bond segment ultimately never had a chance at the overall crown. The best performing bond ETF turned $10,000 into somewhere around the mid-teens. Respectable, stable, useful for diversification, but nowhere near the returns generated by the categories we're about to enter next, because once we move into international funds, dividend ETFs, factor strategies, and especially sector funds, the numbers start getting much, much bigger.